So for those of you that are not familiar with Deckers Outdoors, and I have to admit, when I was first getting into the market, this was one of the real big monster winners, and I was always thrown by the name a little bit because I thought it had something to do with decks. But in reality, it was that UGG boot craze of the early 2000s, which is still pretty popular today. And as you can see in these pictures here, none other than Paris Hilton was probably the it girl of the 2000s, was a big fan and a big wearer of these boots. And having two sisters, I can tell you that they love these boots as well. And so often, most of the companies that you're going to buy, you're going to see that there's interest all around you. Friends, family, or your company is going to be working with the product or working with the service, and it's going to be fairly obvious that it's becoming a bigger part of the world around you. So in terms of fundamentals, I'm not showing the actual statistics here, but trust me, they were there. But just I really want to point out that it's usually, I don't want to say obvious, but the signs are going to be there that the trend is taking hold. And even once you start to see that the product is being purchased by family and friends, there's probably still such a long runway for the stock, because all these trends take time to play out. Before that product is saturated or before all the market opportunities have been taken, there's plenty of time for that stock to give you entries along the way. So you want to look at not only are the earnings and sales there, but do you understand the product? Can you see that runway? Can you see this going on for a period of time where funds are going to be piling into the stock and propelling that trend higher and higher over time? So when you look at this weekly chart, there's just a ton of information to take away from it. All of the elements were there for Decker Outdoors, and you could have seen the product being purchased all around you, and the chart really would have given you so many great opportunities to ride this major trend. Prior to this nice weekly cup with handle that formed, you can see all the buying elements and footprints of major institutions were there prior. Look at the huge buying spikes that took place in late 2005 prior to this major uptrend where the stock pretty much doubled in only a few months' time. And this was really a consistent trend. You can see there was significant buying, and it really held this 10-week moving average for the entire advance. We came through the 10-week line, but there was never any really significant volume, so there wasn't a ton of selling going on in this basing structure. It was really as a result that the market went into a correction. So oftentimes, even the best of stocks, when the market comes into correction, they're going to form their bases. As we spoke about in the market section, 80 to 90% of bases are formed during market correction, so you really want to be attentive to that. When dissecting this basing structure, now that we had this prior uptrend and we knew that the institutions were accumulating the stock, we can see that it was very orderly and there was only a 25% depth. So really it was not too deep, and the length of this base was 19 weeks, so easily longer than the 7-week minimum for a cup with handle. Throughout the basing structure, what I really like and I really find interesting is look at the tight action. If you look at all of these closing prices over multiple weeks within the basing structure, price closed at that same level. Although we traded lower throughout the base, you can see almost each week, except for maybe this one little week here that closed lower in the basing structure, almost all closes were off the low of the base in the upper end of their weeks and all in about the same area. That consistency of closes in a similar range off of their lows is the absolute footprint of an institution. I mean, it doesn't get any clearer than that. As well, each of these weeks closed significantly off of their lows. So all of these weeks that look like down weeks in terms of volume, I would actually argue these are a lot of buying weeks that are going on, because although we dropped lower in the week, by the Friday close, we had quite a bit of upside progress. As the base progressed, you also see a dry up of volume, which is also very nice to see. You want to see the base really coiling up, and you want to see that volume subsides as the market is just basically forcing this base to consolidate. And as soon as that market pressure comes off even a little bit, the stock starts to explode higher. And when we start to move up on the right side, you see that big volume expansion come in. So all of those footprints were really, really evident here on the weekly chart. And although this did make lower lows with the market, you'll see that stock was able to get to new highs prior to the market. So you really had that great relative strength in the basing structure as well. Even if you missed the early entry buys lower on here in the base, which we're going to cover on the daily chart, the stock really should have been on your radar once you saw this relative strength and volume surge on the right side. And there were plenty of other buying opportunities after that, even if you missed those original early entries. And this is why you really want to start with a weekly chart for perspective. This chart, if you were looking only at a daily chart, you would see it be below its 50-day moving average, which is the 10-week line. And maybe you wouldn't have noticed all of these tight weekly closes, or you wouldn't have noticed this subsiding of volume or all these strong weekly closes within the base off the lows of their week. So you really get all the footprints of institutions with the weekly chart, as well as the perspective of the prior uptrend, all these big upward volume spikes that took place. You'll notice all the the largest volume weeks are all up weeks. This shows that there's really an immense amount of buying going on within the prior trend and within the basing structure. That's extremely positive, and especially that relative strength. To see that stock get to new highs before the market, that's really screaming at you that funds are buying this stock. So let's flip now to the daily chart, and let's begin our buying process as well as the position sizing and position building for this company. We're going to keep similar assumptions like we did earlier in the course. In this case, we're going to have an assumption of an account size of $200,000. A full position will represent 25% of the account, or $50,000. Each stock purchase is 1/3 of a full position, or $16,000, $1,700. And that represents also about 6.7% of the total account equity. Our maximum loss for our stop will be $1,500, which is 3% of a full position, or 0.6% of account equity. So this is that same cup with handle we saw on that weekly chart, and you can see here that a number of buy signals started to show up, but also it's very important that you keep that weekly in mind as your perspective, because again, that really helped to show you the footprints of accumulation which might not be so obvious here on this daily chart. And the first buy signal that comes in is multiple signals again. What we have is a kicker pattern here that occurred on earnings, so that's also an earnings buyable gap up on the right side of the base with a kicker. It's also a 50-day stall recovery, so we were hitting resistance on the 50-day moving average here. We were able to finally break above on the right side with this great earnings per share gap up. So we'll be initiating on the open with 1,280 shares at an average of $13.05. Our $1,500 loss is $1.17, so about $11.88, which is indicated with the red horizontal line here on the chart. You'll notice the major volume that comes into the stock. As well, it took place as the market left a period of rather weakness. You can see this is net new lows. There was a consecutive number of periods where we had net new lows, indicating the red background that we covered in the market section. And when that buy came in, we start to flip back and forth between positive and negative. However, the fact that you weren't in a consistently negative environment anymore was showing that there was some strength coming into the marketplace. So there was a little bit of a lifting of that market weight. And after that purchase, we had a move straight to new highs. Now, we prefer not to just buy at new highs. We want to have some kind of a pattern, so you wouldn't be buying here. And traditionally, that's your turbulence zone that we discussed with new highs in the marketplace. And what was a great indication, though, although we weren't buying here, is that we were able to make new highs prior to the market. So you really saw that relative strength come into the market. And so that really alerted you that this is a strong stock. That first buy was a great buy. And now you're going to want to be taking out all of your other buy techniques to add to your position. And the next buy that shows up is the failed breakout pullback to the 20 EMA. So you can see we broke out just barely, and we eventually pulled back to the 20 exponential moving average, and you could have added a second time, which we did here with 1,180 shares at $14 a share. Our total position is now 2,460 shares with an average cost of $13.52. It's 2/3 of a position, about 16.6% of the account equity. And we have that same $1,500 max loss, which is now a 61-cent loss, with our stop at $12.91, which is indicated here with the horizontal red line. So you can see, even though we were buying it as it was coming down, thanks to our earlier purchase and our position building approach, it allowed for such a wide stop because our lower cost kept our average in check, and we were able to survive even a few days that went against us as the stock continued to consolidate. You can see here the stock really started to get going once the market started to move into really positive territory here with multiple days in a row of net new highs. And we break through what is now the handle of this cup with handle, and we add to the position with our third portion with another 1,100 shares at $15.12. So we now have a total of 3,560 shares at an average cost of about $14. This is 25% of account equity. Our maximum dollar loss of $1,500 leaves us with a 42-cent loss per share and a stop price of $13.59, as you can see here with the red horizontal line. Thanks to, again, our position building, we have an 11% cushion at that purchase. So even if there would have been some more turbulence at new highs, we would have been able to withstand some kind of a pullback. But luckily, the fact that we had this great volume kick in and the great relative strength, the stock actually broke away here and started to move immediately from that breakout point. It never really tested you lower. Again, it's also important that you see that breakout on a new high. It's not always important at every one of our buy points, but as I mentioned in the shaper section, you really want to see volume come in on a breakout. That really proves that buyers have taken control and have completely absorbed the supply that was stopping the stock at the prior highs at prior attempts. So that's great to see that volume come in. So now you have a full position, a good amount of exposure of account equity at 25% with a great cushion in a stock that's a potential leader, that's a real hit with consumers, and at the same time is showing relative strength in the marketplace. So all signs are go. We continue to advance rather strongly from that breakout point. So then we hit our next earnings report, as you can see here at the lower portion of the chart indicated with the E. Throughout this entire time now, we've really entered into a strong market period. As you can see, multiple days of net new highs taking place. We gap up on earnings, and we could have added, if we'd like to, here on a pullback to the 8 exponential moving average. I use that as seeing that we had so many great signs that showing this is really a big leader with the relative strength, great volume on the breakout, and we have such a good cost basis, we can really start to now further increase our exposure to this stock. It's a little bit of a more aggressive way to do it, but I want to show you how you can be a little more aggressive if you think that you have a real leader in your hand. So we did the gap pullback purchase, which is another 970 shares at $17.24. Our total position now is 4,530 shares at an average cost of $14.70. This is a pyramided position now, so we have $66,500 or 33% of our account equity. And because we have a 17% cushion at this point, there's no reason to take any kind of a loss. So our max stop is now at our average cost, so a $0 loss. And you can see again the power of position building with our weekly perspective and our daily tactical buys really allows us to have a third of our account in a market leader with no risk to the position, which is absolutely incredible. And after that pullback, we continue to move higher here and the stock continues to trend. Let's move on now to the next chart where the stock continues. I indicated here where the last chart left off, so if you want to print these charts out and study them in further detail, you can keep track. You can see soon after we finally had our first touch of the 10-week moving average here. That entire time, throughout that entire advance, we never touched the 10-week or 50-day moving average. So our first touch of the 10-week came in here. We could have once again pyramided our position since it's a real market leader. As well, the market really stayed in a consistently bullish trend, showing no signs of worry on the market side. And so we add another 880 shares at $18.94. We have a total of 5,410 shares at an average cost of $15.39. And our pyramided position is now 41.6% of the account. So this is really becoming a heavy position. We have no risk to the position and we have a 23% cushion. So you're really in the driver's seat here. You're adding on a nice little pullback. The market action is confirming that you have a market leader and you've been able to build up a great position with very little risk. Now that look on the weekly chart indicates that you have a flat base forming if you go back to that weekly chart, and you really hold the 50-day moving average here, which is really a great sign that institutions are using this pullback to accumulate stock. You don't see any kind of significant down days on big volume. Also, the volatility is very controlled. The size of the daily ranges is not significantly larger than at any other time in the uptrend, so there isn't kind of any greater volatility to make you worry. And again, we have this great gap up out of this base. It's a breakout from a flat base. Again, this breakout occurred with major volume. It was also a kicker pattern. You can see here that we had closed down the prior day here lower than the open, so we had a red candle, and we kicked higher out of this base. So we could have once again pyramided our position. We would have purchased 825 shares at $20.25. We now have a total position of 6,235 shares at an average cost of $16.03. Our pyramided position is $100,000 or 50% of account equity. And again, we have a 26% cushion. We're not going to lose any money on this. But at the same time, we're looking only for shaper sells to exit the position. So once you start to have that great liftoff from the first stage base, already you were only looking for shaper sells to exit. And now this is further confirmation that you should really be patient with this possible major winner and look only for major shaper sells. We start to advance from the base. And again, some other buys do occur. You can see there's another viable gap up out of earnings, but you want to try and avoid adding too close to prior purchases here because it also already represents 50% of account equity. However, how far you want to concentrate, I'll leave that up to you. I probably would have avoided here also because you start to see the market is starting to come into some selling. So no use adding to an already rather concentrated position if the market is showing some weakness. But despite this market weakness, this stock continues to propel itself higher. It's absolutely screaming that it's a major winner. Again, there's nothing better to see than relative strength in your stock. If the market is coming down and your stock will not fall, that's the market telling you that it really wants to own this stock. Funds want to be in there. So you really want to look now for additional entries. And you soon get your first touch of the 10-week line out of your flat base. So we can do another purchase here with 735 shares at $22.76. We have a total of 6,970 shares at an average cost of $16.74. This is really a pyramided position now with $117,000 or 58% of the original account equity. Again, you have a 36% cushion, you're not going to lose any money on this stock, and we're looking for shaper sells to exit the position, which thankfully none have yet occurred. Let's move on to the next portion of this advance. We can see here the last chart left off right here. These are the stats of what our current position was. And so now the stock really gets going and really starts to move into high gear, and it's a complete massive market winner. You can see that the market's really going sideways, but this stock is just tearing higher as all the consumer excitement about the stock, and I'm sure the earnings and sales are fully starting to become absorbed in the marketplace. And after an extended run, you can see volatility starts to come into this stock. And this is where you have to start to pull yourself away from your excitement, your enthusiasm. You have this stock that's really going up day after day. You have to stop and think about all the profits that you're making and all the further profits you're going to make, and you have to pull yourself back, think neutrally, think objectively, and say, are any sell signals coming into the market? And you really want to check both your daily and your weekly charts for those major sell signals. So you can't see it here, but after an extended run, we're actually starting to hit an uptrend line on the weekly chart. Let's flip over to that weekly chart real quick. You can see that prior daily chart was looking at this region here, and we're really up against this major weekly upper channel line that's taking place on the chart. At the same time, you can see you're the furthest away you've been from the 10-week moving average for this entire move. Again, this chart here at the lower end shows the distance of the stock from the 10-week moving average. So you're getting an extreme amount of extension on the upper end of the stock chart here. So when you flip back to your daily chart for that same period, as you're seeing this extension, you can either sell right into it on the extension of the weekly chart, or you can use some of your other daily patterns to exit the position. So you see, either you sold into strength, you could have used a 3 EMA shake-in tactical sell to exit the stock. See, we broke a prior high here after this quick snap down and snap up and closed below our 3 exponential moving average. If you had missed that, this finally did break down and you had your 10-week bad break, and that would have been your shaper sell at 31.68. So really, I just want to show you that in terms of our trade stats, we're going to assume you sold on weakness at 31.68, but in reality, you probably could have sold it much higher up around the $34 mark on this 3 EMA shake-in when you saw that weekly extension. Not only did you have that weekly extension into the upper channel line and that real extension from the 10-week moving average, the market started to get extremely weak at this point in time. So to see your stock overextended into an upper channel line with daily sell signals, tactical sell signals showing up in a weak market trend, you really want to start to now lock in those gains. You've been many months out of your prior base. You can see if we go back to that weekly chart, we've been many months for our prior base. So you definitely have the time criteria in place for a weekly sell signal to sell into strength. Therefore, you could have sold in that $34 region. However, if you would have just waited for that 10-week bad break, you would have sold at $31.68. Now, by selling at $31.68, you would have made $104,000, which would have been a 52% account return on the entire account, which you started with at $200,000. Your hold period was only 56 weeks, so just about a year. And your maximum risk at the start, again, was only $1,500. So you were managed to return $104,000 on a $1,500 original risk. That's 69 times your original risk. Those are the kind of stats that really get you ahead in the marketplace and make up for all of the small little mistakes that you make along the way. I think this really brings home the original point where I mentioned that you want 5 times your risk when looking to build a position. Now, when you just look at your stock in isolation and you look at your daily chart, it's really hard to see how can I tell that I'm going to get 5 times my risk? Well, when you bring together all of the power of the shaper patterns and the fundamentals, and you keep your risk in check with your tacticals, when this works, you're going to get far in excess of 5 times your risk. So in reality, by trying to keep that idea in mind of 5 times your risk, it's really to keep you focused on building a proper position where when you're right, you're going to be very right. And that's really what took place here. And so again, this was a blockbuster trade. It was really evident all around you that people loved those boots. There was celebrities buying those boots. I'm sure if you had any women in your life buying boots, they were buying those boots. I know my sisters and my girlfriend at the time were buying those boots, and you'd see other people wearing them. It was just a complete craze. And when that comes through with the earnings and sales and you get your weekly shapers and you time that with your tacticals, it's amazing the results that you can achieve. And the entire time, Your risk was controlled at $1,500. That was your initial risk. And once the stock started to work, and once the stock showed that it was a real potential market winner, and it had that relative strength, and you had that great respect of the 50-day moving average and 10-week line, it never broke that 10-week line on its entire advance. It was extremely strong. That was really the signs you had a major winner, and the gains were spectacular versus your risk. And if you would have looked at the market weakness, which you can see here again, if we go back to that daily chart, you can see that market weakness here creep in. At the same time, on the weekly chart, you had extension from your averages. You were in that upper channel line. You should have been selling into strength. But if you would have missed that sell into strength, let's go to our weekly chart once again, you had that big volume break at that 10-week line. So let's review. We didn't really take a look at that a moment ago, but you can see after this extended run and you hit that upper channel line, you broke that 10-week line and the volume really swelled. Look at that. This was the biggest volume, not only the biggest down volume week, but this was just the biggest volume week of the entire uptrend. So if you were just kind of, let's say, drunk on the profits and not paying attention, that was something really significant to miss. You absolutely had to catch that, and you had to use that as an exit point, and you would have locked in a major gain. I mean, volume was 90% above average on that breakdown. However, if you were still in that stock and you wanted to give it a little bit more space, did other sell signals show up along the way? Well, eventually, as you start to move higher, the stock did accelerate, and you did get above that upper channel line here, whereas here you only touched it and you showed some signs of overextension. Here, this was the furthest it was from the 10-week line for the entire advance, and you got above that channel line. So it's amazing that upper channel line, when you're months out of a base, it's just a great place to sell into strength, but it's got to be at least a touch point of 3 times. So we touched 1, 2, 3. This was a 4th touch after an initial pause. You got a 4th touch. This was your 5th time that you got through that channel line, so you really want to sell into strength. We got another shaper sell here where we broke the 10-week line again on increasing volume, where volume was 79% above average. So again, when these stocks start to roll over, it starts to become pretty obvious when you keep your shaper sells in mind, and they'll really start to jump out at you. Most winners, when they do fail, they'll fall about 80% from their high. So you do want to exit these positions. You can't just fall in love with the stock. When those shapers come in and you're many months out of a base, you have to look for sell signals. And so either you had your upper channel line, you had your 10-week moving average, and if you were really slow because you were so in love with the stock and you didn't want to sell, you eventually had your head and shoulders pattern here that broke down and had you sell, which was, I would say, a late sell signal, but at least it got you out of the stock before it went significantly lower. So again, this is a great example of how you could have worked with this initial cup with handle buy, use multiple tactical buys throughout this entire uptrend, keep your risk in check, and eventually sell to lock in a huge amount of profit. There was no luck involved. This was patience, experience, and following your rules. Next up, let's take a look at Apple.